Hello and welcome back to Dukascopy TV. I'm Natalie MacDonald. Joining me now to discuss the Eurozone headlines of the day is Mourtaza Asad-Sayed of Société Générale. Mourtaza, thank you very much for coming in.
Hi, thank you.
Now we're going to start off with Greece today, and in what's been described as an incredible turnaround really for the troubled country, investors are now returning to Greece, buoyed by receding fears that the troubled country will be leaving the euro. Is this finally the sign that European markets are beginning to open up?
I would not be so optimistic about Greece. Greece is still in a difficult situation, and the painful structural process is still ongoing in 2 years. What is interesting is that on the margin there are improvements, clearly. Figures on the deficits are a bit better than expected, and we see already a going upward slope for outlook for the ratings. Fitch has upgraded already a little bit Greece on its debt. But what is also interesting is from the market point of view, without even returning to the market, I would not be so enthusiastic about the Greece market, especially given the Cyprus crisis that was not so long ago. What is interesting is that since the beginning of the year, we already saw the international bond on Greek debt, which are usually denominated in dollar or in Swiss francs, which are not the one that defaulted and mostly got restructured, which are denominated in euro, but the Swiss and the dollar bond on Greece market, Greece debt, already traded almost at par for a couple of months already. They're traded at 97 for the US dollar bond expiring in 2013. So the market already sort of relieved the pressure on Greece as a credit risk or as a systemic risk. This is, I would say, is already the story of the earlier of the year. What is more interesting is maybe other part of Europe.
So if, as you're saying, our concern over Greece is kind of done with almost, then where's next really? Where should we be concerned about?
So there is a couple of bursts, and there was a risk in Slovenia. Our take is mostly that the big risk factor for the market, because right now the market are, since the beginning of the year, quite on the upbeat tone. The real risk is the Spanish situation. Not that we expect a default. It's mostly that Spain is just at the fringe of investment grade to high yield. It's just one notch above the high yield. So if there is further deterioration of the fiscal position, or just an issue in terms of lower growth than compared to expectation, which would create lower receipts and then for next year bigger deficits, they could be downgraded. So they're just very fragile on this. On one downgrade would suffice to turn them into junk, which would bring again a liquidity issue, not a solvency issue. It would just, rating agencies mostly are going to expose something that sort of them, we know, but it's just that it has the switch between high yield before investment grade is a big change in who is able to own the debt. And the institutional market, which is pension fund, I would say, quiet money, will have to leave the Spain in big mass just because of regulatory issue that they cannot hold high yield paper. So this one notch is very, very sensitive to what happens then to the Spanish bond market in terms of liquidity and ability of the Spanish government to refinance itself. So far, so good. But we have, I would say, 2 timelines. One is how the Spanish will manage before getting, or if they get downgraded, and the German election in September. So this is who comes first is the big game here. The risk would be that the Spanish downgrade would come before a German election, because this would bring Europe into a deadlock. Because it would be very hard for Germany to show some leadership and to be very constructive on a Euro resolution plan before election, because it would change the outcome of the election and maybe change the perception of Germany or German people in the role and the expense, the cost of being in Europe. If it's after election, whatever is the outcome of the election, the next party, the next leader, even if it's Merkel, could be much more at ease to really build something or have sort of a mandate that doesn't need to go, in front of the electorate right afterwards. So it will make Germany much more in a constructive stance, anything after election. So this is what we're watching. But maybe we're looking for some, factor to get afraid because things are so good on the market. Maybe we're sort of, paranoid. But this would be what we're looking at, is when the Spanish, and if they get downgraded, before or after the German election.
It's very much a chicken-egg scenario, although I'm not sure who's who at present. But it hasn't been a bad day all round, really. I mean, Hungary, for example, today discussed the fact that they're likely to emerge from their second recession in 4 years in the first quarter of 2013. So if we're looking at in terms of European recovery, and we're constantly using this phrase two-speed, and at first it was used to discuss the north and the southern countries, then it was used to discuss the core nations opposed to the periphery nations. Is it really two-speed, the recovery? Is it one speed, or is there just no speed at all?
Right now, the European economy are stall speed. So I would not talk about speed, but in terms of differentiation in Europe, there's clearly two models. There was a demand-driven economies, I would say maybe the South and a little bit of Ireland, and the investment export-driven economy, continental Europe, Germany, of course, but also Switzerland in a sense, and the Nordics, including the Netherlands. What we see is that demand-driven economy run into trouble, mostly because of credit, over expenditure, or even for France, over expenditure on the back of government spending. The migration right now is really to turn those demand-driven economy in more investment-driven, export-driven economy, or at least lower the share of spending and lower the share of spending or support in spending coming from the government. And this is what we're going to see in the French economy. But clearly, right now, the focus is on Spain and the South, because they are more on the crisis situation. Also, there is more an emergency there. But this is pretty much the story of Europe. The other side of, let's say, the export investment-driven economy is not all that fantastic, because they are still very sensitive to the global cycle. So right now the US is quite good, a moderate growth, especially real estate went up. So things are improving, and this is helping a lot those export-driven economies. But the fact that France, Spain, Italy are not doing great is also, hurting those export-driven economies. So they are not immune from everything else. They are very sensitive to the global cycle and even the domestic situation in Europe. We had the European Commission downgrading the expectation for growth in Europe, and they downgraded everybody because everybody has an impact on everybody. So I would say Europe is not going well on average. But there is a big readjustment process to have less disparity in the model. What is, I would say, maybe the core country in terms of average Europe is France. And we see that France will experience a slight recession this year, on average over the year. So that is, I would say, a simple way to see the European speed as a whole.
France will undoubtedly receive more of a kicking sort of between policymakers discussions. Tomorrow we'll see policymakers, chief executives come together for the European Business Summit with a focus on increasing competitiveness within the Eurozone region, but with a distinct lack of capital in order to boost export, import, business models. What really can policymakers do? Is this going to mean further easing from somewhere?
I think the easing is interesting, and maybe in terms of going into capex, I will talk maybe on, I would say, the perspective of the market and the investor in terms of securities more than the investor in terms of capex. What is really interesting is to see that since the beginning of the year, the ranking of markets in terms of stock market performance is really driven by monetary policy. The easy monetary policy brought the country with the best performance, which is Japan. Second is the US. Third is Europe. And last is emerging market as a whole. This is the driver of markets. This is the driver. We can say it's liquidity, but mostly we have to acknowledge that I would say monetary policy is the driver of performance for equities. What brings us for next 6 months is not that much competitiveness. This competitiveness issue is more long run, let's say 5 to 10 year trade deficit, current account balance, export gain and market share. But for the next 6 months is who are going to be the most expensive, most expansionary monetary policy, not the fastest growing economy. And it's possible that we see the ECB taking up more action and the Fed taking a little bit less action. So we could have a rotation here between who is the easiest, with Japan maybe still running high on their quantitative easing of extraordinary size. So we leave the Japan aside. What is interesting is might be the switch between Europe and the US, which will bring, at least for us in our scenario, a stronger dollar. So we are aiming at a stronger dollar, and this could be the flip side, would be a faster European market.
Mourtaza, thank you very much for your comments today. Always
Thank you.
appreciated. That's all we've got time for right now, but stay tuned for more exclusive interviews. Goodbye for now.